Here is the chart nobody on finance Twitter wants you to see this week. Three classic recession indicators just flipped from green to yellow at the same time, and we are still 6 months away from year-end 2026. The yield curve has reinverted on the 2-year 10-year spread. The Conference Board leading index has printed its fourth negative month in a row, and credit card delinquencies just hit a fresh post-pandemic high. None of that screams crash by Friday, but it does change how you should be sizing forex trades on the Exness platform for the back half of the year. Here is why this matters for your majors. When equity volatility spikes and the SPX starts losing key moving averages, global money does not stay in stocks waiting for a hero. It rotates. And historically, the first stop is still the US dollar, even when the United States is the source of the stress. That is the safe haven paradox that catches new traders off guard every single cycle. Watch the DXY. If it pushes above the recent range high while SPX breaks down, EURUSD typically leads the move lower because European growth is already softer and the ECB has less room to cut aggressively. GBP USD tends to follow, but with bigger intraday whips because of thinner London liquidity in a risk-off tape. USD JPY is the wild card. In a slow grind lower for stocks, the yen often weakens against the dollar. But in a true panic session, yen carry unwinds and USD JPY can drop two big figures in a single New York session. Gold is the other piece of the puzzle. XAUUSD has been trading like a hybrid asset all year, sometimes following the dollar, sometimes inverse to it. If real yields start falling because the market prices in emergency rate cuts, gold can rip even with a strong dollar. And that is the setup most retail traders miss. Practical playbook for the next few weeks. Mark the SPX level that triggered the last volatility spike. Mark the DXY breakout level. When both trigger in the same session, that is your highest probability window for a clean dollar trend day on majors. Use the Exness economic calendar to avoid getting steamrolled by surprise Fed speakers, and keep position sizes smaller than usual because intraday ranges expand fast in late cycle tapes. The signals are yellow, not red. That means preparation, not panic. If this breakdown helped you think clearer about the next quarter, hit subscribe and turn on notifications so you do not miss the daily macro update.